Welcome to Ask the Experts. I'm Jill Schlesinger, editor-at-large of CBS Money Watch, and I'm joined by
Jack Otter, executive editor of CBS Money Watch.
We always love to have the following guest with us, Jack.
Yep.
He is the credit guru. I think actually we're going to call him the credit czar. John Ulzheimer, a nationally recognized expert on credit reporting, credit scoring, and identity theft. He is the president of consumer education at smartcredit.com and the credit blogger for mint.com. So he's just be a guy.
And he's wearing kind of a royal color, so I think czar is good.
Yes,
for
I
today.
like czar. I like that. Very, very, very good. And maybe we call your wife the Tsarina.
You should call her that.
I know.
Yes.
I bet you do.
Thank you for having me, as usual.
Great. And by the way, John is also of FICO, Equifax, and Credit.com. He's the only recognized credit expert who actually comes from the credit industry. So he knows all those sneaky, fabulous things.
How novel.
Amazing. So listen, before we get to you, mister, we got some business to take care of. First of all, Jack, we had a kind of a rotten day in the markets today.
Is it down 80 last I saw?
97.
Final number.
How about
Okay,
that?
a little
Down
last
90,
second selling there.
Yeah, just didn't want to hang on to that. Too much anxiety over this whole nonsense in Greece. I have to say, this is becoming a little bit annoying because what's happening is every single morning I have to wake up and do radio, and I start with the Greek drama continues. Dun, dun, dun.
And, you know, we always counsel people not to watch CNBC, so I did it today. You know, do
Just
as
for
I
the heck
say,
of it?
not as I do. I happen to have access to a TV in the Quiet House. So there was some buzz that this comment by Lacker, who's the hawk on the Federal Reserve, that the Fed might have to tighten before 2014 got traders a little bit nervous. Now, this is not Fed policy. This is one guy's comments pulled out of the minutes, probably out of context. The great Mark Toma will be writing some detail about the minutes. But apparently stocks took a little bit of a digger after that on fears that no QE3, which again, you can have political disagreements with, but traders love it because, hey,
Easy
the more
money.
the government supports the risk on trade. And then the idea that the Fed might have to tighten, which could be good for bonds, or actually be bad for pretty much everything.
Yeah, it's pretty much bad for everything. And the only good news would
Except
be
for the
that,
economy
well,
in the long term.
I was going to say that if they're tightening policy because the economy is growing, that's kind of like the good part of it. Hey,
Right.
the
And if you happen
economy's
to like
growing.
actually getting interest in your savings account,
Hey,
could be good. Yeah.
It's the saver's revenge. So I think that the markets and the Greek drama and the Fed anxiety, it really leads to something which is Megan, the producer's favorite topic, which is, holy smokes, stock market's up a lot since October, which she keeps talking about.
Yep.
And although she hasn't sold her CBS stock yet, has she? No rebalancing for Megan. She doesn't like, Jack, she can't appreciate 20% gains since October and take some money off the table.
Nobody can, you know. You see 20, you want another 20. Is it where we're at 30? Have we passed 30?
Yeah, that's yep. So CBS stock at 30. But we were just talking about this because I think people don't realize that we're actually in a bull market for stocks, actually, when you think about it. So the fact that the market's falling off a little bit, I wouldn't get too exercised over. One nice thing is that it looks like the folks in Congress are finally, it's a miracle, not waiting to the absolute last second to agree on the payroll tax cut.
Yeah, it was shocking.
It's responsible lawmakers? Is that an oxymoron?
That is an oxymoron.
I thought
And
so.
I think it had nothing to do with responsibility. I think it's entirely political calculations on both sides, but this time political calculations worked out well.
Yeah, and so we're gonna get what I think amounts to 4 lattes a week. That's what it is. It's $20 a week, $1,000 a year for the average American worker of 160 million Americans who are going to be able to take advantage of this. It's real money. It's good for the economy, and it's certainly something that I think was expected by the markets, but we're kind of happy they didn't wait till the last second.
Yeah, exactly. I mean, we've got to show both sides. I think you and I agree that the behavioral response to getting 20 extra bucks is to spend it, not to save it. This is a little short-term demand. You know, the Journal editorial today pointed out that people don't make long-term investment decisions based on short-term tax cuts, and I think that's true. But I still think this helps with a little bit of boost. I mean, the Moody's and all those other people who served us so well in the crash say that this will add
says sarcastically.
about 1% to gross domestic product. And when we're talking about like 2 or 3%,
That's
one
real.
percentage point is a serious share of that.
It's
Yeah.
for real. And when we talk a lot about the economy and people's willingness to spend, that does bring bring us into today's topic, which is credit. Oh, Jack, I think you have to turn off your phone because Megan's holding up a huge sign.
It should be off. It's on. It's in airplane mode. Yeah, it's not no signal.
She doesn't care. No, boy.
Yeah.
Oh my God.
Uh-oh.
Let me just show you what happened from the production side. Everybody who's watching, this is what Sally did. Back and forth. No, you can't do it. Okay, is it off? All right.
Apparently, you're not even allowed to have your phone on airplane mode when you're on an airplane anymore.
Exactly. You can't do anything.
So it's like the useless mode now.
Right. Exactly. So, all right. Now we're going to have all these people. They have a little extra money, and in their paychecks, we want them to spend. And John, this is a good transition for you. That we also want them. We see these numbers about consumer borrowing on the increase a little bit, and I'm the former financial planner, so this makes me anxious. But it is good for the economy because it's a sign that people are borrowing and feeling more confident. So tell me a little bit about what's going on here, how you see it. Is this a good thing or a bad thing that consumers are borrowing more?
It's great for the economy, but not necessarily great for the economy of one. When consumers get a little bit extra in their paycheck or pay a little bit less for loans, it would be nice for them anyways if they could do some of the things that they have undone over the past few years, which is to replenish that emergency fund that they zapped out when they got laid off or they were underemployed or a spouse was laid off or underemployed. And it would also be fantastic if they started replenishing the retirement accounts. After that, it would also be fantastic if they could chew down all that credit card debt that they got into in Q4, since normally that type of credit card debt is the most expensive because it's usually on retail store credit cards where the average interest rate is 24.9%.
Hold on a second. Let's take a moment there to pause. The average interest rate is 25%?
On retail store credit cards, where your credit score does not matter. Everybody, it's like one size fits all card issuing where
That's astounding. I mean, it doesn't feel like that should be legal.
And there was a huge push on those this season. Everywhere we went, they tried to get me to do the credit card. And
what'd they offer you? I'm curious. 20% off, 10% off?
Yeah, like in the 15% off in one case, 20% in another. And this was, we bought a washer and dryer. Our washer and dryer died at the same time, went to Home Depot. And they offered us this, and you know what? I took them up on it. Our mortgage had already been approved. I've already set it up so we're paying it off. It'll be paid off before the interest kicks in, and then I'll cancel the card. And I realize that's not good for my score, but at this point, I don't think I expect any events. And it was real money.
Yeah.
It was like,
it's a big item.
Yeah.
It's amazing.
About $200.
Let's look at that purchase, but not necessarily something as major as a washer and dryer, but something like a suit or a pair of boots, where you take a 10 or 20% off offer and save yourself $15, $20, and then roll that balance a couple of months. You have just self-funded your own discount, which makes absolutely no sense, and that's what the issuers love.
Yeah.
Wow.
They love for you to do that.
That's amazing. Now, have you been hearing that credit is loosening up a little bit now?
It is definitely loosening up. There's no doubt about that. And it's not just anecdotal. In the third quarter of last year, Citi mailed over $300 million. That wasn't a mistake. 300 million credit card offers. Relatively speaking, that's more than everybody in this country that has a credit report.
Jeez.
So they're remailing a lot of those consumers because this is, credit card extending is largely a timing issue. So yes, they are definitely loosening up across the board. Where a couple of years ago, 750 was the new black when you talked about credit scores. It's not 750 any longer. It is coming down. Now, don't get me wrong, 580 isn't getting you what it got you a few years ago.
A new house in Phoenix, perhaps?
With no income and, yeah, absolutely.
No money down.
But it is true that consumers who found themselves in the mid-600s are now finding themselves able to get loans at something other than loan shark types of terms.
And we read about subprime borrowing is also starting to tick up a little bit. Is that, you've seen that loosen up as well?
Yeah, subprime borrowing seems to be the new ground zero for lenders right now. There is a ton of money to be made if you can get someone to pay, as we said before, 24.9%. And have them not default at the same time. There's a boatload of money to be made there. Look, everybody wants to lend to FICO 780. We all know that there's practically no risk lending into that environment. There's also not a whole lot of revenue lending into that
environment.
environment.
There's no pretty skinny margins there, right?
Very skinny margins, because I'm not going to take, I'll take 7.9%, but I'm going to pay you back in full every month, so you're not going to get anything other than the interchange, which is when someone swipes and the merchant ends up paying, which is, by the way, capped on debit cards now, so it's really not as profitable as it used to be. So I, as a lender, if I'm smart enough to figure out a way to start trickling down and kind of tiptoeing into the deeper end of the credit risk pool, I'm okay doing that because I know my obligations under Dodd-Frank. I know my obligations under the Card Act. They haven't put me out of business, and now I can get back to lending, and that's where there's money to be made, and a whole lot of it, which is why you see the proliferation of so many products being designed tailor-made for that particular type of high-risk audience.
The spread there is incredible. Lending at 24.9% and then paying interest at 0.02%.
Oh,
As
yeah.
long as the person doesn't just blow out on
As
you.
long as they pay you
Right.
back. That's the key. And look, if you think about it, if you ask me to explain to you the most profitable plastic user, what I'm going to do is I'm going to tell you someone who takes their credit card, maxes it out, pays late every once in a while, but never defaults.
Yeah,
The most
that's
profitable
brilliant, right?
customer. But I'm also describing the riskiest customer at the same time.
Jason in our chat room, nice layup here. What's your take on Susie Orman's debit card? Can I just say that she went on some tear? I saw her on my friend Tess Viglin's show, Marketplace Money, and she went nuts on her, like, no, girl, let me tell you.
Yeah.
So you tell us, John, you're the guy from the industry.
Yeah.
Tell us about Susie Orman's debit card.
Well, apparently, if you're critical of her card, you're an idiot or some other derogatory term,
Right.
which I would never ever call somebody for simply being critical of a particular. First off, let's be very clear. It's not a debit card. And some of the marketing around this particular product has become very, very fishy and is bouncing very close to deceptive, if not dishonest.
Ooh.
It is not a debit card. It is a prepaid debit card, which is an entirely different item. A debit card is essentially a plastic check that is tied to deposit at a checking or savings account at a bank or a credit union. It's FDIC insured, okay? A prepaid debit card is not an extension of credit. You don't have to apply for it. It's a product that you simply buy, like you went out and bought a $100 gift card at the mall during the holiday season. It's a stored value product, which means that the value of the card is actually on the card itself, not in an account somewhere. Prepaid debit cards are roundly criticized, and rightfully so, because they set up what I would refer to as an impenetrable minefield of fees. All the way from buying the card, and I'm not just talking about the Susie Orman card, I'm talking about all prepaid debit cards. Almost every single one of them has a cost to buy the card, a cost to load money onto the card, which you're going to want to do from time to time because that's the point of having it. And there's a cost involved every single time you load money onto it. A lot of these have a slew of ATM-related fees, and then what I call just idiotic nuisance fees. A fee for a paper statement, a fee to call someone and ask a question about it, a fee for this, a fee for that.
Even
and
checking your balance on something,
checking
right?
your balance at an ATM. And some of these fees, $1 here, $2 there, $3 here, some of them can get to $20 and $30 a pop, which if you compared the cost of properly managing a debit card with a checking account at a credit union or a bank, it's almost nothing, if not nothing altogether. The cost of managing a prepaid debit card is always going to be something greater than zero. So if you compared the two, and if you're honest about it, not filled with hyperbole, then you have to acknowledge that having a prepaid debit card, which is your money, by the way,
Right.
not a bank's money.
Right, I'm paying you to take my
That's
money and
right.
then use this plastic thing instead
That's
of my
right. And
cash.
structurally speaking, they're no different than a gift card. They're just a gift card with a whole lot more fees. I can go to the mall right now, buy a $500 Visa gift card, pay $2.50 for the actual card, and use it every single place that accepts Visa, and pay nothing more at that point.
And does that do anything for your credit score, though? That doesn't. You're not building your credit in that respect, right?
And neither do prepaid
right.
debit cards.
Exactly.
Prepaid debit cards and real debit cards are not credit products. They're not an extension of credit. Therefore, they're not on a credit report. They don't belong on a credit report. It would be out of place for them to be on a credit report. Now, that's where the marketing Susie calls it the approved card, which is a little bit misleading because you're not actually approved for anything. It's
Right.
like buying a shirt. You just buy it.
You're approved to buy
That's
that
right.
shirt. Thank you.
Yes, there is no approval. There's no underwriting process. There is no credit report review at all. There's been some language around that particular card that the information is going to be sent to TransUnion, which, yes, is a legitimate, nationally recognized credit reporting agency. The information is being sent to TransUnion for the purposes of research, not for the purposes of credit reporting. Big difference.
Yes, I'd say so. That's very different than a secured credit card.
That is correct. A secured credit card, which actually is an extension of credit made by a legitimate bank, will end up on your credit reports if you choose one that does. Some of them report, some of them don't, but it's very easy to see the difference between the ones that do and don't. All you have to do is look at some information about the particular card. You make a deposit at the bank issues you a card with an equal amount as a credit limit, and boom, it starts reporting to the credit bureaus. That's legit. And the fees associated, there are fees associated with secured cards and interest if you revolve a balance. But again, if you can avoid a lot of those, they're not as good as real old-fashioned credit cards, but it's definitely a better alternative than prepaid.
And so, let's get into some questions here. I have a question from Carrie who said, I just declared bankruptcy. How long will it take for me to rebuild my credit? When will I be able to get a credit card?
Well, first off, congratulations, because bankruptcy is a legitimate way of getting out of debt and protecting yourself from your creditors. So if it was a Chapter 7, unless she has student loan debt, then she's debt-free. Mm-hmm. As far as the rebuilding of credit aspect, you might as well go ahead and unpack the suitcase, because it's going to take a while. The credit reporting agencies will maintain record of bankruptcy for up to 10 years from the date filed on a Chapter 7. So 10 years from that date, it's still going to be on the credit report. The debts that were included in the bankruptcy and therefore discharged will only remain for 7 years. That 7-year rule does not change just because they were included in bankruptcy.
So wait, so 7 years
for the debts,
but then 3 years beyond that, it's
for
on
the
your
filing,
credit report.
for the actual public record
it.
filing of bankruptcy. Now, having said that, don't get me wrong, it's not going to take you 10 years to rebuild your credit. If you do the right things, which means start populating the credit report with positive information, it's like a secured card,
right.
Do it right this time around. And most people file bankruptcy for a reason other than they're a bum.
Yeah.
They lost a job, they're underemployed, a death in the earning family, major
illness,
medical.
Right.
Most people don't say, you know what, I'm just going to go into excessive
it's not
debt
exactly
and then
a fun
file.
thing to do.
That's exactly right. So you can rebuild. You'd be surprised how quickly you can rebuild 24 months out the road. You're going to start getting offers from credit card issuers because you are debt-free.
Very interesting.
Now, what are the best first steps? Because obviously it's a bit of a negative vicious circle. If you just filed for bankruptcy, you can't get credit in the standard ways. So is that secured credit card a first step? Is that a second step?
It is a good first step, because I always tell people, and this is FICO specific, not just John Ulzheimer anecdotal. The most impactful item on a credit report is the most recent item on a credit report. So as that bankruptcy ages, which it will do organically, you want to get new and good information on that credit report to prove to the credit scoring system that you have the ability to properly manage credit. And you would be very surprised how quickly your score is going to recover and how quickly credit card issuers and mainstream lenders are going to be willing to do business. Now, you're not going to get 0% off on an auto, or 0% on it. You're not going to get 3.9% on a mortgage, so you're not going to get 7.9% on a credit card. But you're also not going to get 29.9% on credit cards. You're going to get deals that are kind of in the middle until you truly earn your way back into the land of FICO 750.
But you get it. You get your rebuilding, and as you said, these are building steps.
That's right.
Julie wants to know, if I have a credit card with a balance, then open another credit card and transfer that balance to the new card, should I close the original card? If so, how does that affect my credit score? And how does it affect my credit score if I keep both of those open without a balance?
So I would suggest that from a strict credit scoring perspective that she leaves the pre-existing card open, and here's why. Credit scoring systems love to see balance to credit limit ratios that are very, very low, meaning what is your aggregate balance as opposed to your aggregate credit limits expressed as a percentage. If she just transfers a balance from one card to another and then closes the pre-existing card, from the credit scoring perspective, it's almost a wash, especially if those two cards have the same credit limit. But by leaving the pre-existing card open, she's actually going to do much better credit score-wise. Now, she doesn't have to actually keep the card. She can throw it through a shredder if she's worried about something like identity theft. And your liability under the Fair Credit Billing Act is only $50 anyway, so it's really not that. The exposure is just simply not there. If the card starts hitting her with an annual fee that's pretty excessive, yeah, then you might want to think about closing it just to avoid the fee, but keeping in mind that you have this credit score issue always kind of following you around.
All right, well, this is good. I mean, what do we do without this guy? I got to tell you. Ruth,
you'd think that prepaid debit cards would build a credit score. That's what you would do.
I definitely wouldn't do that. Ruth is a 60-year-old professional with a large amount of credit card debt. She's working diligently to pay it down.
Okay.
She is afraid she's not going to have enough working years left to get out from under it. She keeps getting information in the mail and seeing advertisements for credit counseling services. Quote.
Mm-hmm.
And they say, settle your debt for a fraction of what you owe. Is it hype? Is it too good to be true? Is there some benefit to these programs?
So the Card Act, actually, one of the good things that came out of the Card Act is that right on your statement, it will tell you exactly how many years it's going to take for you to pay off that balance if you do nothing more than pay the minimum. And some people they think it's a mathematical error because it's going to take them longer to pay off their cards than it will to pay off their house. Here's the deal. The question suggests to me that you're seeing advertisements for debt settlement companies, not necessarily credit counselors. They're very, very different animals. When I think of credit counseling, I think of the folks from the National Foundation for Credit Counseling who will actually set up a debt management program with your lenders, the nonprofit, the good guys, the white hat guys in the credit counseling industry. Debt settlement is a very, very different issue. The debt settlement guys will actually negotiate with credit card issuers on your behalf for a fee. Nothing is free, my friend.
No, of course. For
a fee, and try to entice them to accept less than the full amount that you owe and then consider the debt to be paid in full. Settling a debt isn't necessarily the worst thing you can do, but you have to understand a couple of things. A, you can do it yourself for free. There's nothing that a debt settlement company can do that you can't do for yourself. Two, some credit card issuers will not work with debt settlement companies, so you'd be wasting your time and money anyways dealing with them. Three, settlement does not protect you from your creditors suing you to collect the debt, all right, where bankruptcy does. Four, if you think your credit's bad now, wait till you settle. And you're going to lock in that lower credit score for an additional 7 years.
Unbelievable.
So just keep in mind, and you're right, Jill, no, it's never that good as the advertisement makes it seem to be.
Jennifer wants to know, do loyalty programs linked to debit cards cause greater usage of those cards?
I would suggest, and this is funny, but in my experience, the folks who use debit cards tend to use terms like love versus using terms like, yeah, I really like that card. They're like emotionally attached to
it's weird, right?
Yeah, and if you remember what happened to Bank of America last year when they imposed a $5 fee for their debit card, I mean, people went absolutely bananas.
Right.
And you don't ever see that when people raise interest rates on credit cards or mortgages. They're like, yeah, whatever. But debit cards, don't mess with my debit card. So I would suggest that loyalty programs, first off, on debit cards are going away. They're going the way of the dodo.
Yeah.
Because it's more expensive now for a bank to issue a debit card because of the cap on the swipe fees, the 21-cent cap that was mandated last year. As far as using your card more, of course it's supposed to entice you to use your card more. That's why loyalty programs are there and rewards programs. They want you to use it more and more and more. That's how they make money. If you're concerned about that, then I would suggest using a credit card instead. And look, I'm not a credit card lover. I don't get paid a dime by the credit card industry. But if you properly use it, you have many, many more protections under the Fair Credit Building Act than you have under a debit card.
Very interesting.
And whatever you do, don't use a debit card in certain instances like buying something over the internet.
Oh my gosh, that's just horrible. Or and
travel, right?
Big time. That's the big one, is
Hotels.
travel. Hotels and rent-a-cars. And I got to tell you, I've been noticing more and more lately that the rent-a-car chains and the hotel chains are doing a really good job of proactively letting their customers know in signage form, hey, look, if you're going to reserve this, if you're going to swipe a debit card for incidentals, you have to be aware that we're going to charge you X times the number of nights you're staying, and we'll settle up after you check out. Well, you got to be careful that doesn't cause you to bounce checks somewhere else.
Yeah, that's right.
Because they've held funds in the credit card world.
And people don't understand that. They freeze that money. Yeah,
they understand it when they start getting
Oh,
swipes
wait a minute,
declined at
I get it,
restaurants.
exactly.
Now, then they understand it.
Paul in the chat room wants to know, will cash in the bank or newly acquired asset like inherited property help my credit score?
It will not. And that's one of the criticisms of credit scores, is it does not consider wealth-related metrics. Having said that, I think we need to be very honest about credit scores. Credit scores are solely dependent on information on a credit report. Right? They don't go out and look for some third-party source of information. If it's not on a credit report, it can't affect your credit score. Wealth-related metrics are also not on credit reports. Things like your income, things like the value of your home, how much you have in your checking and savings account, how much your property's worth, how much equity you have in none of that stuff is on a credit report, so it's systemically impossible for that to be considered in a credit bureau-based credit score like FICO.
And what about these new credit scoring things? You see companies, they're trying to do different kinds of credit metrics. Do you think that has any legs?
I do think it has legs. In fact, there are boutique modeling companies that are kind of popping up out of the woodwork that are evaluating what I call non-traditional credit-related information, like how you're paying your utilities, how you're paying your rent. transactions on credit cards. How does the transaction itself, what does that tell about the consumer? Not necessarily whether you're paying it on time, but where you're using it. You'd be surprised if you look at any of the risk manager forums, they're not asking for more and more credit data. They're asking for more and more non-credit related data so they can make a better decision about you as a customer.
Interesting. Now, let me ask Jack, you're going to ready for this?
I don't know.
Why not? So Jean wants to know, how do I purchase a car without lessening my excellent credit score? I have some upcoming real estate transactions, so I want my credit score to be as high as possible to get the best rate and loan product. So, guys, I'm going to both of you. What happens here?
Well,
wait to do the house first, or maybe you need a car?
Yeah, I mean, I would be inclined, because John has talked about the ratio. And depending on how much outstanding credit you have, if you suddenly have $20,000 borrowed for that car, that's going to affect your ratio.
Well said, Mr. Otter.
Let me quote John Ulzheimer.
There's another thing you should be concerned of here is the mortgage lender, who is yes going to look at all of your credit reports and scores, is also going to take a little measurement called the DTI, or the debt to income ratio. And the minute you close on that auto loan, which is probably going to be fairly significant as far as probably $10,000, $20,000, $30,000, $40,000, that's going to mess up your debt to income ratio. So I would suggest that you close on the house first and then go buy yourself a car.
Perfect follow-up to Donna's question when she wants to know, how does a company determine that your expense to income ratio is too high? And she expense to income.
Yeah, your expense to income ratio is not on a credit report, therefore it's not on a score. It's going to be taken from an application. And there are credit scoring systems that are called application scoring systems that take information not only off of a credit report, but also information that you yourself put on the actual application. That's where you can measure things like income and assets and presence of checking and saving, how long you've been on the job, how long you've lived at the same address, and you can take metrics like DTI and expense to income ratios.
I'm just getting a wealth of information. We had a, you know what, we have a strange email question. Megan and I were trying to figure it out. I think I might have gotten it. It was an email who said that, I think that this person had a consumer loan approved 5 years ago and was paid off. The credit score is now 680. Spouse and she have no debt. They have one credit card with a $3,000 limit. No car loan, no mortgage. My annual income is $65,000. My spouse is $100,000. If we apply for a mortgage now, what do you think the terms we can expect? So let's just go with the most important thing, which is the credit score is 680. There is one $3,000 credit card that's open, not with a balance on it.
Okay.
And nothing else.
Well, if her score is a 680, then something's missing from that equation. You don't have a 680 when you have absolutely perfect credit with zero credit card debt. That's
maybe
more
they
of a
wrote
profile.
something down. Maybe they had like a deal where they wrote down some credit and she paid it off. Maybe they agreed to a lower amount. Could that be in other words, if she says I had a consumer proposal approved 5 years
that's a
ago.
settlement.
Right,
That's a settlement.
So she
proposed an amount,
right?
And the bank accepted that amount, and what in fancy industry lingo that's called settlement,
right?
Which is probably why her score is a 680 versus an 820. Now, 680, she's going to get a mortgage.
Yeah,
she's not going to get the best deal there is to offer, and she may be asked to put more money down depending on the program that her and her husband go under. But she's going to get a mortgage at 680. Now, remember, in the mortgage environment, it's very, very different than any other consumer loan environment, like an auto or credit card. They're going to pull all three of her credit reports and all three of her co-applicants' credit reports. That's 6 credit reports, assuming a husband and wife are going to be applying together. Then the lender is going to take the middle numeric score from each of those sets of 3 scores and then base their decision off of those 2 numbers. So 680 is one of the 5 scores that's going to be evaluated during the mortgage process.
But I think bottom line, given where rates are, they ought to go ahead and do this.
Yeah,
and if they get up to your 820 and lacquer is wrong and rates stay low for another 2 years, they can refinance.
Absolutely.
Well, let me ask you a thing. If you have a 680, okay, would you do maybe a, I know this is crazy, an ARM
There
for
we go.
a few
I knew she was going there.
Would you do a 5-year ARM with the hopes that your credit improves and then refinance, or is that too risky? And what are you going to really get? What's the penalty if you're 680 versus 780? What's the differential on a 30-year fix?
Well, let me just tell you this. A 680 today will get you a better interest rate on a mortgage than a 780 got you 2 years ago.
That's a great stat.
Okay.
Yeah.
6% a couple of years ago was the best interest rate you could get. Today, that's subprime.
Sure. Yeah.
Because the interest rates are bouncing out around 4. So I would suggest, I always tell people, look, leave a little bit for the rats. Don't try to time this to the point where you're getting the absolute floor interest rate, because you just simply aren't going to be able to do it.
Right.
Be happy within thyself. 4.25 is not a bad interest rate on a mortgage, and neither is 4.5, and neither is 4.75. So be happy that whatever you're going to get, even at 680, is historically going to be at pretty much at the bottom of their interest rate curve.
And from your perspective, no matter what, can you just give your little mantra about the couples and credit? Because I think that people get blown away by this. So talk a little bit about what it means to have a credit card with 2 people versus 1, and co-signing, not for a mortgage per se, but for lots of other things like car loans.
Well, I can tell you that when you co-sign for a loan, that the only person who is truly happy about that transaction is the lender.
Yeah.
Because they have 2 people who are liable for the payment and susceptible to the collection actions. And if it's unnecessary to qualify for the loan, like a credit card, I don't know anybody in their right mind who would jointly apply for a credit card. You don't need 2 incomes to qualify for a credit card. Same thing for an auto loan. It's if you're buying a car that requires 2 incomes, I suggest that you're buying too much of a car.
Yes, right.
Sure.
Now, that's understandable for a mortgage, obviously, especially depending on where you live. But otherwise, I would always at least consider the possibility of maintaining credit independence. And since Valentine's Day was just around, just a couple of days ago, or just yesterday, and that's the day that more people get engaged than any other day during the year, that's a great thing to talk about right now, which is, honey, I love you, but you're not going to go on my credit card. I'm not going to go on yours. And the only way we're going to be financially linked together credit-wise is if we buy a house.
One question on that house. Let's say you don't have to go together on the house.
Right.
But you mentioned that it's nice for the bank because there's 2 people they can come after.
That's right.
So do you end up getting a slightly lower rate if you've got 2 incomes promising?
Not necessarily.
Huh.
Absolutely not. This is all about risk.
Okay.
And if your set of 3 scores has a middle one that's good enough for the lender to give you a prime rate, which today I think it's somewhere around 4. It's been around 4 for a while. Take it and rock and roll and be done with it. There is nothing, and I realize that I'm being, Professor Buzzkill, and this is so unromantic, maintain independent paths of credit. But I think if you look at the divorce rate, and I know it's not 50%, but people love to say that it's 50%. Let's just say it's significant. You can't demingle or unmingle commingled debt.
Right.
Because even divorce decrees do not supersede your original contract with your lender. And if the lender is not a party to the divorce decree, which they never are, because divorce attorneys are really bad about this, then you may walk out of the courtroom thinking, okay, Jill is responsible for all the credit cards, I'm responsible for the home loan, and that's it. But the lenders may say, you're both still jointly liable for everything, so if you don't make payments, we're coming after both of you.
And even in a lesser situation, let's say, you space out and forget to pay a credit card bill. Or if you've kept everything separate, then, okay, you're the bozo, and your wife is the one who, buys the washer and dryer with the store credit
exactly
card.
Right, you always have like a plan
But if you
B.
commingle everything, then one mistake and you're both good.
You are so right. And it's not easy to get those little mistakes off your credit reports, but it's so nice to have the clean party in the relationship who doesn't have that issue to deal with for the next. And how long do those stay on a credit report? 7 years.
Oof. That's brutal.
7 years. It is brutal. And look, it's what the law. Everyone likes to blame the credit bureaus for this stuff. It's the Fair Credit Reporting Act is very clear that they are allowed to maintain this stuff for a full 7 years. So if you want the rules changed, it's got to start with the Fair Credit Reporting Act.
Interesting. Can we just finish up with a little student loan action here? Because the amount of new loans for education is ballooning.
It's nuts.
And some people, Jack, have said that student loan debt could be the next bubble.
Yeah.
And how is that possible?
Well, the awful landmark that we passed last year was student loan crossed was it the 1
Trillion.
trillion mark,
Trillion.
more than outstanding credit card
That's
debt
right.
for the first time. And You know, I've talked about this with the people at my college, which we will not name now, because they were looking to me to help them raise money since I can't afford to give them anything, but I work in communications, so they figured maybe I could make some phone calls. And I said, look, the one complaint I have is nice football field, nice new arts center, but would you just keep a cap on the tuition? And they said, you know what, we'll charge what the market will bear. And that really bothered me, actually.
It's
Sounds like a lender.
Yeah, exactly. But what the market is bearing it by increasing the student loans, and the return is getting less and less on these.
Can I point out something that I think is just ironic and points out just how silly this entire it proves that the credit environment is not without some form of humor. It is impossible for an 18-year-old to go open a credit card today if they don't have an income or a cosigner. The Card Act now makes that an illegal act for a lender to do. However, I can go obligate myself to hundreds of thousands of dollars of undergraduate and graduate student loans with no problem. It makes absolutely no sense, which is why you're exactly right. A couple of years ago, we talked about how student loan debt was, oh my gosh, it's even with credit card debt. Now it's left credit card debt in its wake and has blown through the $1 trillion mark. And guess what? You don't have bankruptcy as a safety net because a lot of that is statutorily not dischargeable. So the question is as well, okay, I can die with it.
That's the only way you beat them, right?
Well, there are some...
Because I thought that the federally guaranteed ones, they don't come after you. So it really, if really the only answer is you have to die to beat them, it's not a very good resolution.
It's a terrible way to think about it. But yes, the problem is that if you default on credit card debt or any other normal consumer loan, in some states they can't even sue you for it because it's a one-action state. The California is a great example of a one-action state. If they foreclose on your house, they can't come after you for the deficiency. You're done.
Right.
And as long as you just ride out the 7-year credit issue, you're fine. Student loans, they can start doing things like taking away VA benefits. They can attach your tax returns. They can attach Social Security. So it's not as clean as defaulting on any other type of consumer debt. If the government guarantees the debt, they're going to get something back out of it versus just forget about it.
So what should you be looking for when you're, either you're a parent or you're a student in terms of student loans? Do you have ratios that you like to sort of build out that you think are good to live by? Or, if you don't have a lot of choices, what do you suggest?
Well, I have a very, very unpopular perspective about, and it's probably because I don't have children at the college age yet, so I'm not going through it personally. But my perspective is, I would even address it before it gets to the point where you have to start looking for money, and I would start addressing it when you start at the process of looking at schools. And I think one of the issues that parents and kids run into is that if they get into a certain school, they feel like they have to go there.
Right. You can't say no to Williams.
You can't say no to Notre Dame. You can't say no to Stanford. You can't say no to Brown. You can't say no to a damn good but an expensive college, right? And that's troubling because you end up graduating with 6 figures in student loan debt and a degree. I had an email from a guy the other day who said, I have $70,000 of student loans and I'm making $35,000 a year now. What should my strategy be for repaying it? And I'm thinking,
well.
what are you doing? What in the world are you doing? You got a killer graduate degree in art and now you can't find a job that is equally fulfilling financially that you can pay it off. And that's the issue. Don't necessarily forget the massive network of community colleges and state colleges where you can get your core curriculum done at a much more competitive rate and then transfer into the big name schools where the degree is actually going to come from, and you're going to save yourself a boatload of money, and you're not going to save all of the money, but you're going to save a ton of the money.
And you'll still have that degree.
And you're
Jack,
still going to have the degree.
But you like to sort of, you say it depends how much you're going to make, but you don't know sometimes. Like, let's say, you enter college and, I don't know, you get into Middlebury, you can't say no. And you don't know how much you're going to make. Maybe you thought, I'm going to be an investment banker, and that may, coming out of college, I'll make $120,000 a year. The financial crisis hits, you can't get a job.
Yeah, there's certainly no guarantee. I do think that if you are committed to that art degree, and you know that you're going to paint and log cabins are cool with you and you don't need a whole lot of heat, then you know that $70,000 is a bad idea.
Right.
If you're a great student in high school, you got away with numbers, you're committed to a career in finance, I think it's a risk that might be worth taking.
And do you think it's okay to accumulate, say, whatever your salary is going to be, like 1 times that? In other words, you come out of school and you say, okay, my first year salary is going to be $120,000. Can I accumulate 120 or can I accumulate 250? I mean, what do you
That's
think?
a big number. Yeah. You could, and I think it really depends on the individual, their risk tolerance, their family situation.
Right.
You know, can dear old dad swoop to the rescue in that case if worse comes to worse, or is there no chance of that?
I think you really have to be careful, and I think that coming from a privileged elite education, I would also say that it ain't worth it if you're going into hock up to your eyeballs. It really isn't. I don't care where you go. You can go to Harvard or you can go to MIT. It's just it is that weight of that debt is so emotionally debilitating. I think you don't realize it when you're in college and when you get out and your choices are curtailed.
Right.
Maybe you would prefer to take a job where you're a finance professor and you feel like, oh my God, I got to go work for the man because
the man.
I'm carrying the debt.
We should point out, though, that this is not an excuse not to go to college. This
No,
is simply your choice of college.
Because you're going to make a whole lot more with the college degree than you will make without one. And one of the arguments, like the counter argument to my perspective on this, is that my alumni connections from Wake Forest are a whole lot better than your alumni connections from the University of West Georgia.
Right.
At the end of the day, I'm writing a check every single month, not my buddies who I went to school with.
That's a very
it's
good
me
point.
who's writing the check. And if those contacts yield a profession that is rewarding financially to the point where I can write that check and laugh, then fine. But if not, then it doesn't matter who your connections are.
We should point out the unemployment rate for college graduates right now. No one's going to believe me. 4.3%.
Yeah. And so that's
This is not a recession among college graduates. This is a recession among people who don't have college degrees.
Yeah, although it has increased, right? Because the before the recession, it was like 2 something,
yeah,
right?
exactly.
But yeah, I mean, it's about half of where the national level is, 4 points lower. It's pretty amazing.
That is surprising.
You know? So John Ulzheimer, nationally recognized expert on credit reporting. And I might add, the only recognized credit expert who actually comes from the credit industry.
It's just boggling that there
Plus,
aren't more of us.
A fantastic colored shirt today.
Thank you so much. You like
Really,
that?
I think you're looking very smart today.
Thank you so much.
We want to thank you so much for joining us. We'll always have you back because you always make us smarter about these issues about credit. If you've got a question about credit and we didn't get it, or you're maybe watching this after the fact, send us an email, asktheexperts@moneywatch.com. We can always send it off to John and he'll answer those questions for you. We want to thank you so much for watching, and thanks so much for John for joining us.
My pleasure.
And Jack,
Great to be here as always.
with your white shirt.
Yeah, I'm in the doghouse on the shirt color. Next time I'm coming with my purple.
But a sweet tie, I might add.
Well,
I'm
thank you.
Jill Schlesinger. He's
Jack Otter.
And thank you so much for watching Ask the Experts. We'll see you next week.